Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Welcome, everybody, to April's ICW. Apologize for being late, but here we are. I hope you like roller coasters because it seems like that's what we've been going through the last few months. I got a brick wall behind me because it feels like I'm banging my head against a brick wall. Every single day to hear about tariffs, no tariffs, what's going on. There's a lot of movement in the markets. There's a lot of uncertainty out in the economy. We have an election coming up in 2 weeks. We have, down south, a man that feels like he can say and take away and say again different things. But hey, Sherry, I don't know about you, but I was hoping for a 0.25% cut. It only, a bit of a surprise that it was, well, maybe not, it was 50-50, so it wasn't a surprise, but it was no change. What are your thoughts?
Well, it doesn't surprise me that they've held off because they're clearly concerned that they maintain their inflation fighting bona fides. And though inflation released yesterday was only 2.3%, down from 2.6 the month before, they know that tariffs put upward pressure on prices, and they also realize that this may be the last time that they can skip a rate cut. I happen to think that they presented two scenarios, neither of which is likely, and that what will actually happen will be a recession this year and rate cuts.
Well, and that's, you said it. Everybody knows there'll probably be a recession this year. They talked about a lot of weak data that came in, employment. Obviously, inflation came in better than expected. Consumption, residential investment, business investment, they're all down. Spending's down. Consumer confidence is down. So what a better time that you would think to give that signal and say, hey, as the Bank of Canada, we get it. Let's diminish the rate, give people confidence. Let's soften what's coming. But they didn't do that. So that's very interesting to me. I know it was a 50-50, but I thought, man, he's going to come through. But I guess I was wrong.
Eddie, reading the minutes of the last decision date meeting they had, there were a number of people that raised the issue of, well, inflation has ticked up a bit and maybe we shouldn't be cutting rates. So
they're made up for last month's cut by not cutting this month. Okay, yeah, that makes sense. Okay, well, listen, let's get through the presentation. As usual, let's let Sherry complete her presentation. We do want you to send your questions in. We'll get to those questions at the end. Sherry, I'm going to hand it over to you.
Thank you, Eddy. Okay, well, hello, everyone. We certainly live in interesting times, maybe too interesting, at least for my taste. But here we are in the midst of clearly what is a major tariff threat And there's no question in my mind that Trump is determined to take on China and Canada. Why he seems a little more sanguine about Mexico, I don't really understand. But there's what the Bank of Canada did today, which was in their monetary policy report, they presented two potential scenarios for the economy. One, like not so bad, the economy slows this year but rebounds next year and inflation remains relatively muted. And the second scenario is big recession this year, slowdown continuing into 2026, and inflation moving above 3% next year. I believe what will happen is something in between those two. I think what we'll see is a recession this year and inflation picking up in a few months, not in when they release the data next month for April, because of the big decline in oil prices, as well as the elimination of the consumer carbon tax, will keep inflation low. But I do believe that even by the next meeting, the incoming economic data will confirm that the economy is slowing considerably, that confidence has declined, sentiment is very negative, financial conditions have deteriorated, people have experienced declining wealth as a result of the stock market sell-off and even the reduced prices of homes. And so interest rates will come down substantially. I don't want to get into too much detail on exactly what the bank says. They're forecasting because they keep saying they really don't know what will happen. And that is truly where we all stand. None of us know what will happen. Trump has made it very clear that tariffs are his favorite thing and that one way or another, the whole tariff debate will continue for some time. I think that the best thing that could happen for Canada would be if the Prime Minister can convince Trump to begin the renegotiation of the Canadian free trade deal, and put to rest some of the negative comments that Trump has made about the unfairness of Canadian trade with the U.S. because it's not at all legitimate. So one of the reasons he is so much in favor of tariffs is because he needs cash. The U.S. has a very large budget deficit relative to the size of the GDP, much higher than in Canada, much higher than in most countries in the world. And Trump wants to extend the 2017 tax cuts. Tariffs would generate revenue, and so that's part of the reason. The other part of the reason is he really does believe that foreign trade is in some ways negative, because anyone who has a trade surplus with the U.S. is punished by the threat of tariffs. Now, just to put that into perspective, you can see from this chart that Mexico, Canada, and Vietnam are the most vulnerable in the trade war with the U.S. because Mexico, Canada, and Vietnam have the largest trade surpluses with the U.S. When the only reason that he provided a 90-day postponement for the reciprocal tariffs is because the subsequent massive sell-off in the bond market that led long-term interest rates to spike higher. And over the course of the weekend, not this past weekend, but the one before, many corporate leaders and financial leaders attempted to get in touch with Trump or his people to tell them what a big mistake they're making. In addition, the way they measured reciprocal tariffs is completely bogus. And I won't get into the nits of that because it's kind of complicated, but trust me to believe that it misrepresented the degree of trade restrictions that other countries impose on the United States. The reason the US has trade deficits in goods with other countries is because the US is the richest country in the world with strongest consumer and business demand. And so it's not surprising. In addition, the US economy needs to import certain products from around the world because they're not produced within the United States. That's always been the case. But for whatever set of reasons, Donald Trump has it in his head that he's going to bring all manufacturing back into the United States. And as a result, the US will flourish. Nothing could be further from the truth. This looks at trade deficits for China, Canada, and Mexico, and the EU with the United States. And you can see the US trade deficits with different countries. That for Canada, which is that teeny little orange bar, the trade deficit the US has in goods with Canada is extremely small. And also you see that as a result of all of this tariff discussion, there's been a plummeting in consumer confidence and business confidence. Businesses suggest the outlook is deteriorating rapidly. Consumer confidence is at rock bottom lows, and there's already evidence that consumers are tightening their belts. Business investment has slowed substantially. Now, this chart looks back at the tariffs that were introduced in 2017 through roughly 2019. 2019 was the first full year of tariffs, and the U.S. suffered. They lost 43,000 factory jobs, industrial production contracted, business investment stalled, median household incomes fell. Consumer earnings were hit. All of this was negative, and somehow the U.S. doesn't seem to remember any of that. Now, Canada is the U.S.'s second largest trading partner, but it is also the number one export market for American goods and services. So the Trump attitude towards Canada is irrational. It's not consistent with the reality. Canada has the second lowest trade deficit in goods and services with the US. And if you exclude Canadian energy exports to the US has a trade surplus with Canada. The US is far less dependent on exports than any other country in the G20. You can see the U.S. exports as a percent of the GDP is extremely low. It's shown in that pale blue bar there. And you see it's much, much lower than virtually any other country. Trump has said that the U.S. is losing $200 billion a year to Canada and characterized it as a subsidy. I don't know anyone who has figured out what that 200 billion refers to. It's an incorrect number. And our trade surplus with the United States in goods is not a subsidy. Sure, the U.S. pays for the products that it imports from Canada, but it receives all of the goods and services that it is requiring. Canada makes 10% of American cars and purchases considerably more in proportionately than in fact it produces. So again, this is a benefit to the US economy. And here you see that Canada is the largest exporter of steel and aluminum to the US, and there's a 25% tariff right now on steel and aluminum exports to the US. So this again it is not possible for the US to produce all of the steel and aluminum that it needs, nor is it possible for it to produce all of the automobiles within the domestic economy. It's not even clear that in time, that kind of onshoring of manufacturing would make any sense at all. Not to mention, the US unemployment rate is still extremely low, and they don't have the workers to produce all these goods and services. So there's nothing about this that most economists would think of as representative of a reasonable trade position. Here you see that Canada's exports of food to other countries and the exports to the United States for food is very, very strong. So again, another example of just how important Canada is. But unfortunately, exports of goods and services as a percent of GDP is 34% of the Canadian economy, 77% of which goes to the US, whereas for the United States, the exports of goods and services relative to GDP is a mere 11%. So as difficult as this is for the US economy, it is far more deleterious for Canada and other countries. So the US is the export destination for 77% of Canadian goods traded. No other country accounts for greater than 5% of our export volumes. As well, we're the largest export destination for US goods, followed by Mexico and China. The full onshoring of all non-US auto production would require a 75% boost in US production and $50 billion in new factories. This would significantly decrease the profitability of the US auto companies. And the auto companies are lobbying Washington hard for a change in their attitudes towards autos. They've imposed, or say they will impose, a 25% tariff on autos, not auto parts, but autos that are exported into the US on the proportion of that automobile that has non-US content. By the way, calculating, or how one would go about calculating that, is very problematic because the auto crosses the border so many times between Canada, US, and Mexico. It would be guesswork, merely guesswork, for a company, for Canada to know, in fact, what exactly they would owe in tariffs based on Canadian content. US exports to Canada and Mexico are almost triple exports to China, by the way, and yet it's really China that is feeling the biggest blow for tariffs right now. Canada and Mexico have retaliatory power, but of course the threat is there that the more we retaliate, the bigger the tariffs will be from the United States. So again, the whole thing is a catch-22 and not good news at all. And the U.S. is acting as though they haven't benefited from free trade, but this chart shows you that they certainly have. Since the introduction of NAFTA and then latterly the USMCA, this chart shows you what stock markets have done in Mexico, Canada, and the U.S. since that time, prior to the tariff talk. And you can see the U.S. as, without a doubt, seeing the strongest stock market performance of any of the other countries. The U.S. has benefited significantly from free trade in North America. Trump also says that the U.S. needs to step up oil production. The drill, baby, drill policy is profitable only if oil prices average about $78 a barrel. And now oil prices have moved down sharply, so they're hovering around $60 a barrel. The U.S. has a significant amount of oil. The real emergency is the lack of inexpensive power generation. And that's why Canada exports electricity to the United States, because of our inexpensive hydroelectric power. China, by the way, is already at peak oil demand. And so this means that oil prices likely will continue to be relatively weak. The energy and automotive sectors are key because there are no alternative sources that can meet U.S. demand. In addition, primary metals, including steel and aluminum, food and beverage manufacturing, chemicals, machinery, aerospace are the sectors that are most vulnerable to potential tariffs. The U.S. government has also suggested that they'll be imposing restrictive tariffs on everything from softwood lumber to pharmaceuticals and other important products coming from Canada. In addition, the U.S. has been hurt by the dramatic decline in Canadian tourism into the U.S., which has always been a U.S. surplus in terms of roughly $15 billion in travel trade. The tariffs that have already been suggested are the highest tariffs since 1909. So even though he keeps changing and reneging and postponing and then adding more, this is without question, without precedent, and also it is causing enormous volatility and uncertainty in the global economy. And this just shows you the stock market since Trump took office. And we've seen some improvement since the 90-day reprieve on the retaliatory taxes, but it's been a very mixed stock market performance even since last Thursday when he announced the postponement. So instead of a soft landing, which is what I had been predicting prior to the Trump inauguration, we are now on the precipice of a hard landing. I'm forecasting less than 1% growth in 2025, and in 2026, we start to see an economic recovery. Looking at this in a little more detail, looking at a quarterly basis, you see that fourth quarter GDP growth in Canada was 2.6%, boosted by the checks from the federal government and the provinces to individual Canadians, as well as the GST holiday. I do think, though, that as we move into the second and third quarters, we will see recession in Canada with a bounce back in activity next year. But this assumes that the Bank of Canada does cut interest rates further. If they do not, then that recession becomes much deeper and more prolonged. But I believe they will cut interest rates. We've also seen that Canada's GDP per capita growth has fallen sharply, and there's a stunning divergence between performance, economic and financial performance, in the US versus Canada. It is unprecedented in the post-war period. And we've seen substantial labor market deterioration as our unemployment rate increased, and there are already layoffs directly attributed to the tariffs, and certainly much more to come. We've also seen that mortgage payments relative to after-tax income are much higher in Canada than the US. Another example of the much greater interest rate sensitivity in our country compared to the US economy. And another reason why it would be very important for the Bank of Canada to cut interest rates further. So the March data just released last week for Canadian employment showed a net decline of 33,000 jobs. Job growth weakened sharply, and the unemployment rate ticked up. So again, already evidence that the Canadian labor markets are slowing. Wage inflation has ticked down, and overall inflation fell to 2.3% year over year in March, which some believed that in itself would warrant another rate cut by the Bank of Canada today. But they didn't take that opportunity. So you see here that the inflation numbers fell from 2.6% to 2.3%. And we are expecting for April inflation of 2% or maybe slightly below that, both because of falling oil prices and the elimination of the consumer carbon tax. So inflation really isn't the big problem right now. The core inflation numbers are hovering around 2.8, 2.9%, which of course is higher than what the Bank of Canada would like to see. And the breadth of inflation is rising again, meaning this shows you the share of CPI components that are growing at over 3% annualized rate, and that share is now just over 40%. It had been as low as about just under 25% not too long ago. So inflation pressures were already mounting before tariffs were in the news. And this shows you that core measures of inflation have ticked up as well in Canada. So the Bank of Canada is on the sidelines for now, emphasis on for now, because I don't think it will be long before they resume the rate cuts. This shows you that they held the overnight rate steady at 2.75%. That's down 225 basis points from the peak in the overnight rate at 5%. And the US and Canada's central policies have never diverged as much as they are right now. Overnight rate spreads in Canada versus the US are about almost 200 basis points, which is a record gap. The 5-year yield did spike in recent weeks. It's sold off a little bit since then, 2.70%. That's right on top of where it was the last time the central bank met back in March. So volatility, selling of US Treasury bonds by foreign entities is likely, and the US&D is, though the inflation numbers are pretty good in the US, there's the safe haven of government bonds is not nearly as powerful as it was historically because of all of this massive disruption beyond tariffs that's very evident since Trump took office. I'm sure you all know about Elon Musk and his Doge and how he has gone in and tried to fire thousands of government workers, cut programs, etc. The courts are now getting pretty active in trying to forestall all of this, but we're in the midst of what is a constitutional crisis in the US, as the Supreme Court has demanded that the Trump government return Mr. Garcia to the United States, the guy that was unfortunately sent to the El Salvador prison without any reason. And whether or not Trump actually does comply with the Supreme Court, I don't know, but it certainly will continue to cause a fear of a constitutional crisis, if not actual crisis. This shows you the decision dates for 2025, and you see that I believe that when the bank meets again on June 4th, they will take the overnight rate down in 25 basis point increments. And in my view, given the recession that I'm forecasting, I think the overnight rate is headed for as low as 2%, or at least certainly 2.25% by summer and fall of this year. This remains above the pre-COVID rate of 1.75%, but certainly it would be very good news for the housing market if we could see a further significant decline in mortgage rates. Now, the Canadian data on housing were released yesterday as well, and we saw a substantial slowdown in home sales. Home prices fell and new listings rose. So still, the housing market's under a tariff cloud, and consumers are just very uncertain about the future and therefore reluctant to move off the sidelines. But there is undoubtedly pent-up demand for housing. Now, this shows you that March home sales fell 4.8%. month over month. This shows you the typical seasonal pattern of home sales. And normally this time of year, as we move from March to April to May, normally home sales pick up sharply. And we had expected that we would see a big pickup in home sales, but the tariff has obviously diminish those prospects, unfortunately, at least for now. So big decline in the first quarter for the residential sales activity. New listings ticked up in the first quarter, and market balance, you see, we're rapidly approaching a buyer's market, at least in Ontario and British Columbia. And you see that The sales to inventory ratio has plunged as sales have slowed and inventories have picked up sharply. National home prices fell again in March. So this shows you regionally, the blue bars are home resales and the yellow bars are new listings. So again, with the exception of Montreal, you see home sales are down in these cities and new listings are up. So again, contributing to what will be a buyer's market. We've also seen the payment shock as half of Canadian mortgage come up for renewal this year and next year. And though people did have to qualify at higher mortgage rates, higher than current mortgage rates, it still means that monthly payments are going up. And we've seen that delinquency rates are increasing across the country as well. So again, with the exception of Alberta and the prairies, this is a phenomenon everywhere, and arrears will likely continue to rise. Now, in this uncertain environment, home buyers, no question, they're deer in the headlights right now. I do believe as interest rates fall further, mortgage rates fall further, home prices decline, and more supply is available, people will move off the sidelines. What we've seen is an increase in the popularity of fixed relative to variable mortgage loans over the course of the last few years. Now, roughly 50% of new mortgage borrowing is in the 3 to 4 year fixed rate loans. Overall, 23% are fixed less than 3 years, 10% fixed 5 years or more. Variable rate mortgages were picking up before these tariff scares began. But now that everyone is concluding that tariffs will be negative for inflation, those who are risk averse, no doubt, will stick with at least short-term fixed mortgages going forward. The immigration story has been incredible also, in that we know that the government said that they were going to cut immigration, but they have been even more aggressive in cutting than we had expected. For this year, we're going to see less than 400,000 new permanent residents, planned permanent residents. We did see temporary entrants at 800,000 net new temporary workers and foreign students were accepted in 2023. The government wanted to slash that. Well, they certainly have. Foreign student permits have plunged 45% to 280,000 in the last year, and it's down from 650,000 foreign student permits issued the year before in 2023. So population growth is already slowing dramatically. The latest data available showed that for the fourth quarter of 2024, population growth was at a mere 1.8%, the slowest level in 2.5 years. And this shows you again that here I'll go back, the population growth declining means that the numbers now are more in line with our construction capacity. But the construction sector also has a shortage of labor, and without temporary workers coming into the country, it will become an even bigger problem. So it's also likely that population growth will slow further in 2026. So big declines in population, and slower population in and of itself reduces economic growth and inflation. So all signs point to slower growth, ultimately inflation under control, but interest rates at the end of the day will be much lower than where they are right now. Thanks a lot, Eddie. I'm happy to open this up for questions.
Yeah, I have one for you. It's going to be a tough one. So when does this stop? Like, what happens, or what has to happen that, this all gets settled, and how long will that take in your mind?
Well, of course, the answer is I don't know. And no one knows, not even Trump.
Okay.
That I'm very nervous about it because there are no experts right now in the Trump cabinet. There's nobody on, like in charge of the Treasury or in charge of the Office of Management and Budget or the other, even the Commerce Department. These are business leaders, but they're not trained in understanding the intricacies of all of this, and they keep making mistakes, big mistakes. So I think it was a mistake for the Bank of Canada to refrain from cutting rates today.
I do too. Yeah. Okay. Well, let's get to the questions, because I think we have a few here. One is the bond rates, the bond yields. So Suresh asks, what's happening there? Is this normal at a time like this, higher bond yields? And we saw a fluctuation of that bond yields. At one time, they're down at 2.4. They looked like they were just steadily going to go down, and then they popped up to over 2.8, and now they're settling around 2.7, 2.6. So what's driving that? Why so much, volatility? What are your thoughts on that?
Okay, well, in past financial crises, the U.S. bond market always rallied because the Treasury market is the deepest, most liquid market in the world. And it's seen as a safe haven, just like gold. Only this time, gold is surging, but bond yields are rising instead of falling. In other words, bond prices are falling. And that's because foreigners don't trust the U.S. government any longer. So the last thing they want to do is bury their money in the U.S. And also, another development that's contrary to everything we've ever seen before is that over the course of the last couple of weeks, the U.S. dollar has fallen. Like, the Canadian dollar has risen, despite the fact that our economy is closer to recession than the U.S.
Yeah, that signal is very strange, isn't it?
It is very strange.
Okay, let's get to the next question. Chris Murphy asked about Carney's discussion with Trump last week, the focus on U.S. Treasuries. Any comments on that?
Well, I think what the big important thing that Carney discussed with Trump, according to the media, is that they want, once the election's behind us, they want to renegotiate the free trade agreement as soon as possible. Because it's the free trade agreement that Trump negotiated back in 2018-19, the free trade agreement is what created the automobiles industry sectoral movements across 3 countries. And similarly, the oil inflow from Canada to the United States, all under free trade, no tariffs. So, and it's to the U.S.'s benefit that they do this, certainly the benefit of the American automobile companies. So I'm hoping that they've slated a renegotiation of the free trade agreement for 2026, but the sooner the better to dispel all this uncertainty. Sure. But whether or not they actually do that, it's not as though they have little to think about. They're busy negotiating deals with countries all over the world. So this is going to stay with us for some time.
Sounds like it. Okay, so let's get to our next one. So Mortgages by Mark. He asks, are we headed for stagflation? Are we going to see some stagnant? Or maybe even the opposite? Are we going to see disflation? Did I say it right?
Well, stagflation means recession and inflation at the same time.
Okay.
And that's possible certainly for some period, but I think the dominant factor from the fallout of this tariff war will be economic slowdown worldwide, and that means less inflation than if the economies were strong.
Okay, and then he follows up Mortgage by Mark by asking about the conservatives versus liberals, their impact on our economy going forward. So will there be a bigger impact from one party to the other, or will their policies be pretty much the same?
Are we talking about policies in Canada or policies in the United States?
In Canada, I think the question is.
Yeah. Okay. Well, yeah, there would be differences. We all know that the conservatives are very much more popular in Alberta. They'll be more energy friendly, less concerned about environmental protections. But you know, I don't think that from a housing perspective, it would make that much difference. I think regardless of who wins, interest rates in Canada are coming down and the economy is going to hit a recession, probably beginning very soon.
Yeah, I think the policies on housing, they both have like positive policies on housing, building more houses, tax breaks, etc. So, one may be better than the other, and of course, I highly recommend you read through the policies as you're voting. But the good news is they both have policies when it comes to housing.
Yeah, right.
Okay, let's go with Jason Nugent. What does Trump do to turn this around in theory, especially with the loss of the trust in U.S. trade?
I don't think he's going to do anything.
Yeah.
I think he thinks he's doing a great job. I honestly don't see him as, quote, coming to his senses. I mean, this whole thing, he's had 4 years to think about all this. And they are doing exactly what they said they would do in Project 2025, that report. I encourage all of you to read a summary of it. Just ask any of the artificial intelligence sites to give you a summary of Project 2025, and you will see that the list of items, Trump has already used executive orders to at least try to accomplish everything from deportation of illegal and even some legal immigrants to tariffs and on and on. And there's no question that tax cuts, especially at the high income levels and for corporations, is the next shoe to drop.
Okay, so Sean Humphreys, this is a question about CPI, the basket of goods that are increasing over 3%. It's about 40%. Do you think this is a concern for the Bank of Canada? So let me try to break that down. So obviously there's a basket. It includes, fuel or gas, housing, food, etc. He's saying that ones that are over 3% is about 40%. Is that higher than normal? I don't know. And you think that's a concern?
Well, it is a concern because they are inflation targeting 2%, and we're above that. But there's nothing like a slowdown in economic activity to mitigate that pressure. And if we get the kind of slowdown I'm expecting, we will certainly see inflation pressures diminish.
Okay, let's two more questions here and then we'll wrap up. It's after the time. I know we started late, but let's go to Nancy Ingram, and she talks about Trump targeting Canadian travelers. Like, that's interesting. It's billions of dollars, but he seems not to care. What are your thoughts around that? Is that going to be, I think as someone said, it's just like a drop in the bucket when it comes to GDP. So he probably doesn't care.
Yeah, but just because he doesn't care doesn't mean he's right not to care.
Yeah, I don't know. I don't disagree. That's, yeah, absolutely.
You know, like, I mean, he's totally wrong in doing this. I mean, in terms of foreign travel to the United States, Canada is number one,
Right.
Canadians. And that's obvious, you know, it's closer and our economies are more integrated. We speak the same language, etc. So that didn't surprise me that we're the number one foreign. But what they're doing is alienating Canadians. And everyone knows all the comments he's made. But even beyond that, now if you're residing in the United States for more than 30 days, you have to register online with Homeland Security. That's outrageous. You know, I mean, it's just, I can tell you, I know people who have sold properties in Florida because they just don't want to be here anymore. So it's a very stupid thing for the U.S. to be doing this.
Yeah. So that registration, like how much is that gonna turn off Canadians? Is it onerous? Is it onerous to register? I just don't know.
No, you go online to Homeland Security and you fill in a bunch of forms, but you do have to, you know, provide all sorts of details about yourself. And evidently, from what I've read, that at the borders they can request looking at your phone, and you know, it just
that's just a reminder to be careful what you post, right? Because everything is public, and I've heard that too, where you go to the border and they look at your phone, and if you're anti-Trump, they may have a problem with you and could deny you to get into the country. So just a lesson there to be careful how you portray your feelings on social media.
Or take a burner phone going to the U.S.
Take a burner for that. That's look at Sherry. I hope your phone's okay.
I'm American and Canadian, so I don't have to register.
Oh, I was going to say that. Okay, so because you're a dual citizen, you wouldn't have to. Right. Okay. Well, Sherry, thanks so much. As usual, you are awesome. You know, I think you're right.
I wish we had a happier story, Eddie, but I do firmly believe that before the end of this year, the housing market is going to come back in spades, because there really is an opportunity, particularly for first-time home buyers. There's a lot of product available. Prices are going down. Sellers are motivated. And interest rates are going to.
Did you see that comment there? I don't know if you saw that. Put that back up. Look at that. My parents in their late 70s sold everything in Florida after 40 years.
Right.
Like that's how strong Canadians are in their feelings when it comes to patriotism. Like they are. It's amazing. It's incredible. And I mean it's sad too, right? I mean they probably love Florida. Right, Susan? Yeah. I mean, they probably loved going there, and they probably loved where they are. They built incredible friendships, and now they got to let it all go. Unfortunately, it's crazy.
Yeah, it's very sad. It really is. And I mean, I feel comfortable here, and I can't talk about it. Because no one talks politics here because we are friendly with our neighbors, and we don't really want to get into an argument because these arguments are ugly.
Oh, I can imagine. We have relatives from the U.S. and we don't talk politics either because it never ends well. On that note, I agree with you. I believe there are some tremendous opportunities. I believe that buyers are going to come off that fence and they're going to do it quickly and in massive amounts. There is definitely a buyer's market out there. Opportunity is in front of you. I think it was Phil Soper said this morning that out of the 50% that were on the sidelines because of that confidence piece, Only 17% of that 50 were worried about affordability. So that means there's a lot of people ready to buy, can afford to buy, but are waiting to buy. And I believe, and I'm with you, Sherry, that that's going to come all at once rates settle, once, we get a government in place and we know where we're headed, that our market is going to rebound. So be prepared. Make sure you're communicating with your databases, communicating with your prospects, communicating with your teams, and just be ready, because I really believe that it's going to come fast and furious. Thanks so much for joining us. Until next time, have a great day.
Thank you. Bye-bye.